Did you catch what just happened and why the headlines are almost certainly pointing you in the wrong direction? Silver just touched $88.16. That's an all-time high. Gold is over $4,600. And if you've been tuned into the financial media today, they're telling you this is about electric vehicles. They're telling you it's solar panel demand. They're calling it a healthy industrial bull market. Before we go any further, help me out with something real quick. Subscribe and turn on notifications because the next few days could move fast, and I don't want you catching this after the move is already gone. I'm here to tell you something different, and I need your full attention because what's actually pushing this move could force you to rethink portfolio protection over the next few weeks. This isn't about solar panels. This is about a potential Supreme Court decision that could dump a $200 billion obligation onto the U.S. Treasury. And if that sounds dramatic, good, because the math is dramatic. The implications are dramatic, and the fact that most people still aren't connecting these dots is exactly why I'm recording this right now. Here's what I'm going to walk you through today. First, I'll explain the Supreme Court case sitting on the docket and why it matters to anyone holding dollars or dollar-denominated assets. Second, I'll break down what I'm calling the fiscal flight to quality mechanism, a fancy phrase for what happens when smart money realizes the government may be heading into a cash crunch it didn't plan for. Third, I'll show you the actual numbers from this morning's trading, including some very unusual price gaps between Eastern and Western markets that should make you uncomfortable. Fourth, I'll address the skeptics, because I know some of you think this is just more precious metals hype. And finally, I'll tell you exactly what I'm watching and what my personal plan is if certain triggers get hit. This is moving fast, so let's get into it. Pause. The case at the center of all this involves Trump-era tariffs, specifically the tariffs imposed between 2017 and 2020 on hundreds of billions of dollars worth of imported goods, mainly from China, but also from Europe and other trading partners. The legal challenge argues that these tariffs were put in place without proper congressional authorization, violating the Constitution's separation of powers. Now you might be thinking, okay, so what? Tariffs get challenged all the time. Fair question, but here's where it gets interesting. If the Supreme Court rules that these tariffs were unconstitutional, the remedy isn't just stopping future tariffs. The remedy is refunds. Refunds to every importer who paid those tariffs over multiple years. We're talking about companies that paid tens of millions, sometimes hundreds of millions, in what would retroactively become illegal taxes. And under U.S. law, when the government takes money illegally, it has to give it back, with interest. The estimates on the total liability vary, but the consensus among the legal analysts I've been following puts it somewhere between $180 billion and $220 billion. Let's call it $200 billion for our purposes here. That's the working number. Now, $200 billion is not a small number, even for the U.S. government. But here's the critical piece most people miss. It's not about whether the Treasury has $200 billion in some abstract accounting sense. It's about the timing and the mechanism of payment. When a court issues a judgment like this, there are deadlines. There are legal requirements for how quickly refunds must be processed. And unlike normal budget items that can be stretched over years or buried inside omnibus spending bills, court-ordered refunds create immediate liquidity demands. The Treasury doesn't have $200 billion sitting in a checking account for emergencies. That money has to come from somewhere, and there are only three places it can realistically come from: cutting other spending, raising taxes, or issuing new debt. Cutting $200 billion in spending quickly? Politically impossible. Raising $200 billion in new taxes? Same problem, which leads to door number 3. The Treasury has to go to the bond market and borrow $200 billion it wasn't planning to borrow, and that's where the precious metals market starts paying attention. Let me slow down and explain the mechanism, because this is the teaching moment. This is where you need to understand not just what's happening, but why it matters. When a government faces an unplanned, massive debt obligation, what we call a fiscal shock, something changes in the minds of investors. They start doing the math. They start asking uncomfortable questions. Question 1, how is this going to be paid for? And as I just laid out, the answer is almost always new debt issuance. Question 2, what does that do to the existing debt? And this is where things get tight. If the Treasury suddenly needs to issue $200 billion in new bonds to a market that wasn't expecting it, one of two things happens. Either they find buyers at current interest rates, or they have to offer higher interest rates to attract those buyers. In a normal environment, the Treasury can usually find buyers, but we're not in a normal environment. We're in an environment where the 10-year Treasury yield has been climbing. We're in an environment where foreign central banks have been reducing their holdings of U.S. debt. We're in an environment where the bond market is already showing signs of stress. So if the Treasury comes to market and says, we need another $200 billion and we need it fast, what happens? Either yields spike to pull in buyers, Or the Federal Reserve steps in and buys the bonds itself, which is just a polished way of saying they print the money. Both outcomes are poison for the dollar. Higher yields mean the government's interest expense blows out, which creates a debt spiral where you borrow more just to pay the interest on what you already borrowed. And if the Fed prints the money, you're directly devaluing the currency. This is what I mean by fiscal flight to quality. When investors see this kind of setup forming, they don't wait for the full-blown disaster. They move capital out of the currency and into assets that can't be printed. Historically, that's been gold, but increasingly, it's also silver. And here's why silver moves like a rocket when this happens. Market cap. The entire above-ground silver market, physical silver that exists in investable form, is tiny compared to the bond market. It's tiny compared to the gold market. So when the exit door out of the dollar gets crowded, silver's door is smaller, less supply, more violent price moves. Think of it like this. Imagine a bank realizes it's been overcharging customers for 5 years. Suddenly, a judge orders them to refund every penny by the end of the month. The bank doesn't have the cash sitting there. They have to borrow it at whatever interest rate they can get just to keep the doors open. That whatever interest rate moment is the fiscal shock. And the customers who hear about this early, the ones who start pulling deposits before the public announcement, those are the people buying silver right now. That's the mechanism. Pause. Now let me show you what it looks like in practice. This morning, a few hours ago, I was watching my screens and the numbers were striking. Silver spot price, the ask side, was 88.16. That's up 4.45% just today. Gold was at 4,611, platinum at 2,350, palladium at 118.70. Those are the numbers you can see on any financial website. But here's what you won't see unless you're watching specific markets. The Shanghai Gold Exchange, which is the primary physical trading venue in China, was showing silver prices equivalent to $98 per ounce when you convert to American dollars. Let me say that again. New York is pricing silver at $80. Shanghai is pricing it at $98. That's a $10 premium. In normal markets, you get small differences between regions, shipping, local demand, currency conversion fees, $1 or $2, maybe $3 in extreme cases. But $10 on an $88 asset is about an 11% premium. That doesn't happen in a functional market. What that tells me is that physical silver is being pulled out of Western vaults and shipped east as fast as it can be moved. When you see a gap like that, what you're watching is arbitrage. Traders buy in New York at $80, sell in Shanghai at $98, and pocket the difference minus shipping costs. But here's the problem with that arbitrage. It only works as long as there's physical metal available to buy in New York. And when you're moving hundreds of millions of dollars worth of metal based on a $10 gap, vaults empty fast. I'm not saying we're at that point yet. I'm saying the gap is a stress indicator. It's telling you the physical market and the paper market are starting to separate. And when that separation lasts more than a day or two, you can end up in dangerous territory where the Western price becomes irrelevant because there's no metal available to buy at that price. The other number I'm watching is the dollar index. The DXY has been relatively flat today. It's not showing the kind of collapse you might expect if the dollar was already in visible crisis. That matters because it suggests the mainstream market hasn't priced this in yet. The bond market is still behaving like everything is normal. Currency traders are still acting like everything is normal. But the silver market isn't. Silver is vertical. And that divergence, the gap between what silver is doing and what the dollar index is doing, is your early warning signal. It's the canary in the coal mine telling you a small group of very smart, very well-connected traders are positioned for something the mainstream still hasn't figured out. Now let me address the demand story because I know that's what you're hearing everywhere. The narrative is silver is rising because of industrial demand. Electric vehicles need silver for electrical systems. Solar panels need silver for photovoltaic cells. The green energy transition is happening and silver is a key ingredient. All of that is true. Industrial demand for silver has been growing, but context matters. Annual industrial demand for silver is around 600 million ounces, roughly half of total silver demand. The other half is investment demand in jewelry. If this move was purely industrial demand, you'd expect a gradual trend over months or years as factories ramp up and supply chains adjust. What you wouldn't expect is a 4.45% vertical move in a single morning. That's not how industrial demand behaves. Industrial buyers plan purchases, they hedge, they lock in prices through long-term contracts. They don't panic buy at all-time highs. What drives a 4% move in a few hours? Financial flows, investment demand, capital rotating from one asset class into another because people are worried about the value of what they're leaving behind. So when I see silver up 4.5% in a few hours, and I know there's a potential $200 billion fiscal shock, and I see a $10 premium in Shanghai, I don't think solar panels, I think currency hedge. Let me take you through the math of what a $200 billion Treasury obligation means in practice, because this is where people lose the thread. $200 billion sounds big, but it can still feel abstract. So let's make it concrete. The current U.S. national debt is around $36 trillion. The annual interest expense at current yields is around $1 trillion. That's $1 trillion per year just in interest payments without paying down principal. Now, if the Treasury has to issue $200 billion in new debt, yes, it adds to the $36 trillion. But the bigger issue is what it does to the annual interest expense. At a 5% yield, roughly where the 10-year Treasury is trading, $200 billion in new debt means about $10 billion per year in additional interest expense. On its own, that might not sound catastrophic, but here's the compounding effect. The bond market isn't stupid. When the market sees the Treasury show up with surprise issuance, it demands a higher yield for added risk. Maybe it wants 5.2% instead of 5%. Maybe it wants 5.5%. And here's where it gets nasty. U.S. debt doesn't sit at one interest rate forever. As old bonds mature, they roll over into new bonds at current rates. So when rates rise, the interest expense across the whole debt pile rises over time as rollover happens. If the Supreme Court decision pushes yields up by even 0.5%, you're looking at an additional $180 billion per year in interest expense across the entire debt stock as it rolls. That's $180 billion per year, every year, until rates come down. And how do rates come down? Either the economy breaks and the Fed cuts to prevent a depression, or inflation gets so bad the Fed has to hike even harder to fight it. Neither scenario is good for the dollar. This is what I mean by debt spiral. A fiscal shock leads to higher borrowing costs. Higher borrowing costs lead to more borrowing. More borrowing raises borrowing costs again. And somewhere in that spiral, investors lose confidence in the currency's ability to store value. That's when they buy silver. Now let's stress test the Shanghai scenario, because this may be the more immediate risk. If the $10 premium between New York and Shanghai stays open for another 48 hours, you could see massive physical flows out of Western vaults. The London vaults, which are the primary storage and trading hub for precious metals in the West, hold somewhere around 1 billion ounces of silver. That sounds huge. But at the scale we're talking about, it isn't infinite. If the arbitrage window stays open, you could easily see 100 million ounces or more move in a week. And if the market starts suspecting London is running low on deliverable silver, that's when you get a force majeure event. That's when the exchange says, sorry, we can't deliver physical metal at the paper price. Settlement becomes cash or delayed delivery. And once that happens, once paper decouples from physical, the paper price becomes meaningless. The only price that matters is the physical price. And that physical price gets set by whoever has metal and whoever is desperate enough to pay for it. I'm not predicting this happens. I'm saying it becomes a risk scenario that grows more likely the longer the Shanghai premium stays elevated. And right now, this morning, it's at $10. That's elevated. Let me hit a checkpoint here so we're all aligned before we move forward. Here's what we know so far. There's a Supreme Court case that could create a $200 billion refund obligation for the Treasury. That obligation would likely be funded with new debt issuance, which would either spike yields or require the Fed to print. Either outcome is negative for the dollar. Smart money that sees this setting up starts moving into hard assets like silver. Silver's up 4.5% this morning, which looks more like financial flows than industrial demand. And there's a $10 premium between New York and Shanghai suggesting physical metal is being pulled out of Western vaults. That's the setup. Now let me deal with the skeptics, because I know some of you hear this and think I'm being alarmist. Skeptical argument number one: the $200 billion refund will take years to grind through bureaucracy. The Treasury isn't going broke today. This is slow, not a crisis. And look, I understand the instinct. Government moves slowly. Legal processes can drag. It's absolutely possible this gets tangled in appeals or implementation delays for months, maybe longer. But here's the thing about markets. Markets are forward-looking. They don't wait for the crisis to be obvious. They price it in the moment it becomes credible. If the Supreme Court rules these tariffs were unconstitutional, even if refunds take 2 years, the market prices the liability immediately. Liquidity doesn't leak out slowly. Liquidity can vanish in seconds. The moment big institutions decide U.S. Treasury bonds are riskier than they assumed, they reduce exposure. And when trillion-dollar institutions reduce bond positions, yields can move fast. So the idea that we have years to prepare misses how markets actually behave. And once that happens, once paper decouples from physical, the paper price becomes meaningless. The only price that matters is the physical price. And that physical price gets set by whoever has metal and whoever is desperate enough to pay for it. I'm not predicting this happens. I'm saying it becomes a risk scenario that grows more likely the longer the Shanghai premium stays elevated. And right now, this morning, it's at $10. The market reaction happens now. The fiscal pain hits later, and by the time everyone agrees it's a crisis, positioning is already over. Skeptical argument number 2, especially common in the precious metals community: high yields kill silver. Why hold silver, which pays no yield, when you can get 5% risk-free in treasuries? In normal times, that logic holds. Higher yields compete with precious metals, but we're potentially moving into a fiscal crisis. And in a fiscal crisis, high yields don't represent a juicy, safe return. They represent risk. Ask yourself, why do yields rise? Because buyers demand more compensation. When the Treasury offers 5%, it's not generosity. It's the market saying, we need 5% to take this risk. If yields spike to 6%, 7%, 8%, that isn't an opportunity. That's a warning siren. That's the market saying, we're not sure you can pay this back, so we want to be paid for that uncertainty. When the bond market is on fire, you don't stay in the burning building just because the yield is high. You get out. Historically, where does money go when it exits bonds during fiscal stress? Hard assets. And I want you to notice something right now. The 10-year Treasury yield is moving up alongside silver. They're not moving inversely like they often do in calm markets. Both are rising. That's your signal the old rules are breaking. That's your sign we're not in a simple high yields versus precious metals environment. We're in a fiscal stress environment. Skeptical argument number 3, the dollar index isn't collapsing, so how can this be a dollar crisis? Good question, and it's worth answering cleanly. The dollar index measures the dollar against a basket of other currencies: euro, yen, pound, Canadian dollar, Swedish krona, Swiss franc. And right now, those currencies have their own problems. Europe has debt issues. Japan has fought deflation for decades. The UK went through a bond market crisis a couple of years ago. So if the dollar index stays flat, it doesn't automatically mean the dollar is strong. It can simply mean the dollar is less weak than other weak currencies. It's a relative measure, not an absolute one. Silver is different. Silver has no central bank. Silver can't be printed. Silver doesn't get rescued by fiscal policy. Silver is silver. So when silver goes vertical, while the dollar index stays flat, it suggests the problem is systemic. It's not that the dollar is uniquely weak, it's that fiat currencies broadly are weak relative to hard assets. And smart money is figuring that out before the mainstream does. All right, let's talk about what happens next, because this is where the rubber meets the road. This is where you start thinking about positioning in scenarios, not just theory. First thing I'm watching is the institutional reaction. Specifically, I'm watching the CME, the Chicago Mercantile Exchange, where silver futures trade. When a market goes vertical like this, the exchange has a pressure valve. It's called a margin hike. Margin is the cash you must post to hold a futures position. If you trade silver futures, you might put up 10-15% of contract value and borrow the rest. That's leverage. When volatility spikes, the exchange can raise the margin requirement. Instead of 15%, maybe you need 20%, or 25%, or 50%. And when that happens, leveraged traders must either add cash or close positions. If they can't add cash, they sell. If a lot of traders are forced to sell at the same time, price drops. That's how exchanges cool off a move that's running too hot. I expect the CME to use it. I would not be surprised if by market close today, or tomorrow morning at the latest, we see a 25-50% margin hike on silver futures. Is that automatically bad? Not necessarily. It depends on how you're positioned. If you're trading paper silver on heavy leverage, margin hikes can wipe you out. But if you're holding physical silver, margin hikes don't touch you. In fact, forced selling can create buying windows in the physical market. So I'm not panicking about a margin hike. I'm expecting it, and I'm watching how the market behaves afterward. Second thing I'm watching is media coverage. And yes, this might sound conspiratorial, but I need you to understand how financial media behaves during crisis setups. There's often a 24-48 hour period where major events get downplayed or missed while connected players position. I'm not saying there's some smoke-filled room controlling coverage. I'm saying financial media depends on official sources. They wait for statements from the Treasury, the Fed, major banks, and those institutions don't comment in real time. They wait, they assess, they craft language. So you often get a lag. The market moves first, and the narrative catches up later. During that lag, retail operates on incomplete information while institutions act on fuller information. If this Supreme Court decision is as significant as it could be, I expect media to pivot to it within a day or two. But right now, the story is still industrial demand. And that gap between what the market is pricing and what the media is talking about is your edge as an informed investor. The other thing I'm watching is technical difficulties on price tickers. And I know that sounds paranoid, but I've been around long enough to see it. During the 2011 silver spike, as silver approached $50, there were trading halts, platform outages, and delayed price feeds on major services. Was it deliberate? I don't know. Maybe it was just volume overload. But the effect is the same. Retail can't see prices or execute cleanly, while institutions with direct access can. So I'm watching for that. If your brokerage app starts freezing, if price feeds stop updating, if orders take unusually long to fill, that's a signal the market is under stress. Pause. Now let me give you my personal dashboard, what I'm watching over the next 48 hours, and how it informs what I do. Indicator number 1, the Shanghai Premium. Right now, it's $10. If it crosses $12, that tells me the physical shortage is getting critical. At $12, the disconnect is too large to wave away as normal friction. That signals the Western price is becoming less relevant and the real price is being set in the East. If I see the premium hit 12, I become very cautious about assuming physical can be bought at paper price. I'd start thinking about paying premiums to lock inventory before it becomes unavailable at any reasonable cost. Indicator number 2, the US 10-year yield. Right now it's around 5%. If it crosses 5.5%, that's a bond market stress signal. That's buyers demanding materially more compensation to hold US debt. If the yield hits 5.5 while the Supreme Court decision is still pending, it suggests the market is leaning toward worst-case outcomes. That's when I start thinking about shifting more capital into physical assets, because a bond market in trouble is a currency problem in slow motion. Indicator number 3, the government response. If the Supreme Court rules against the tariffs, I'm watching for any announcement of a stay or delay. If there's a stay, that relieves immediate pressure. It gives the Treasury time to plan. It gives the bond market time to adjust. If that happens, I would expect silver to pull back, maybe toward 75s, maybe even lower, because the panic cycle cools. At that point, I'd be looking for re-entry levels at better prices. But if the court rules and there's no stay, if implementation is immediate, that's when things get interesting. That's when the fiscal shock becomes real. Pause. All right, let me walk you through my personal battle plan. And I want to be very clear, this is not advice. This is not me telling you what to do. This is simply what I'm doing, based on my risk tolerance, my capital, and my read of the market. Your situation is different. Your plan should reflect that. Right now, this morning, I'm not chasing this vertical move with fresh long positions in paper silver. The move already happened. We're at all-time highs. Buying at $88 after a 4.5% jump doesn't offer me attractive risk-reward. If I didn't already own physical silver, would I buy here? Probably not. I'd wait for a pullback, but I do own physical silver. I've been stacking for 12 years, so I'm sitting on gains. My question isn't, how do I get more exposure? My question is, how do I protect what I already have? Here's my first trigger point. If silver hits $92 today, I'm looking to hedge my physical stack by buying put options on SLV, the silver ETF, not because I think silver is headed for a lasting crash, but because I think there's real risk of a margin hike-induced sell-off that could drop price $10 or $15 quickly. If that happens, I want to be hedged. I want downside gains to offset paper drawdowns on my physical holdings. Then if we do get that sell-off, I can close the puts for profit and potentially use that profit to buy more physical at lower levels. That's how I'm thinking about near-term volatility. Not bullish or bearish, but how do I avoid getting whipsawed while staying long-term positioned? My second trigger is the 10-year yield. If it crosses 5.5%, I'm moving a portion of my liquid cash into physical metal, even if premiums are high. I know that sounds counterintuitive. Why buy into premiums after saying I'm not chasing? Because if the bond market is signaling liquidity stress, the premium becomes secondary. What matters is having the metal. What matters is not being trapped holding cash or bonds when everyone suddenly realizes they'd rather hold something else. In a real fiscal crisis, you're not optimizing your entry. You're trying to get through the door before it closes. And at 5.5% in this context, that door starts closing. My third trigger is government response. If the Supreme Court rules and the government announces a stay, I'm sitting tight. I'm not selling physical, but I'm not adding either. I'm waiting to see how this develops over weeks, not hours. But if there's no stay, if implementation is immediate, then I treat it like potential black swan territory. And in black swan territory, you're not obsessing about perfect positioning. You're thinking about survival. You're thinking about holding assets that can't be diluted by policy decisions. Pause. One more indicator I'm listening for. More subtle, but important. The rhetoric from the Federal Reserve. If the Fed starts talking about maintaining orderly markets or ensuring liquidity, that's often code for intervention readiness. Fed intervention during fiscal stress usually means printing. It means quantitative easing. It means expanding the balance sheet. And that's bullish for hard assets over the medium term, even if it creates short-term volatility. So I'm listening for language cues. I'm listening for signals the Fed is preparing to backstop the Treasury. Because once the market believes the Fed will print to stabilize the system, that's when currency devaluation accelerates. That's when silver doesn't stop at 90 or 100. That's when people start talking about 150, 200. I'm not saying we're there yet. I'm saying I'm watching for the signals that point in that direction. Pause. Let me also address the safety piece, because I know some of you are thinking about leverage, about using margin, about trying to maximize returns. I want to be direct. Be careful. The volatility we're seeing right now, 4% moves in a morning. This is the environment where leverage destroys accounts. You can be right on direction and still get wiped out by a margin call on a temporary pullback. If you trade this, use capital you can afford to lose. Use position sizes that let you sleep at night, and know exactly what you'll do if price moves against you. For me, the only leverage I'm willing to touch in this environment is options, and even then, I'm using them defensively. Hedges, not aggressive directional bets. Physical metal, metal I can hold or store in a vault I control, that's my core. Everything else is tactical around that core. Pause. All right, let's bring this home. Let me recap what we covered, and then I'll give you my read for the next few days. We've got a potential Supreme Court decision that could create a $200 billion obligation for the U.S. Treasury. That's not some distant future issue. That's a decision that could land any day. And if it does, the fiscal shock is immediate in market terms. Silver is at $88, an all-time high, and today's move looks like financial flow behavior, not slow industrial demand. The $10 premium in Shanghai suggests physical metal is being pulled out of Western vaults at a serious pace. The bond market isn't fully pricing the crisis yet. The mainstream media isn't connecting the dots yet. But the silver market is. And that gap, what silver is doing versus what everything else is doing, is your signal. Over the next 48 hours, we'll find out if this is a flash spike or the start of something bigger. We'll see whether the Shanghai premium holds or closes. We'll see whether the CME hikes margins. We'll see whether the Supreme Court rules or delays. And through all of that, here's the question you have to ask yourself. Am I positioned for a scenario where the dollar loses credibility, not just value against other currencies? Credibility as a stable store of value? Because that's what fiscal shocks do. The dollar doesn't go to zero overnight. Confidence erodes. People start asking new questions. Assumptions that held for decades begin to crack. And when those assumptions crack, when people start wondering if the U.S. can manage its debt burden without printing or defaulting, hard assets become more than an investment. They become insurance. Here's my rallying cry, and I mean it. The mainstream narrative wants you to believe this is a demand story. They want you thinking this is all solar panels and electric vehicles and a smooth industrial transition. And sure, industrial demand is part of the picture, but it's not the whole picture, and it's not the main picture. The main picture is financial stress. The main picture is a system built on debt that can't realistically be paid back without debasing currency. The main picture is that we may be one court decision, one fiscal shock, one liquidity crunch away from a repricing of everything, and the people who understand that are not waiting for CNBC confirmation. They're not waiting for the Treasury to admit there's a problem. They're moving now. Don't be exit liquidity for the banks. Don't be the person who only connects this after everyone else is positioned. Watch what the market is doing, not what the media claims it's doing. This is moving fast. The next 48 hours could be decisive. So whether you're buying, selling, or holding, know why you're doing it. Think through scenarios. Have a plan. I've shared mine. I've shown you the triggers. I've explained the mechanism. Now you need your own map. And if you want the historical blueprint for what currency erosion looks like when it accelerates, I've got a deep dive on the Weimar silver roof from the 1920s. It's a template for what happens when a government tries to print its way out of a fiscal crisis. The link is in the description. Stay sharp, watch the indicators, and don't let anyone tell you this is just about solar panels. Beat. If the next shock hits and the crowd rushes for the exit, will you be one of the people already positioned, or one of the people still asking what happened? Let me know in the comments below.